Good morning, my name is Gianluca Santi and I'm the General Manager of Business Development and Corporate Communication of the Unipol Group. As in every quarter, I'm going to take you through our financial results. Business in the first half of this year, along with the figures I'm going to comment on, were marked by the COVID-19 pandemic and by the lockdown period. The time frame and the degree of the ensuing crisis are still difficult to foresee, as well as its real effects on the insurance sector. Let me remind you that in the first half of last year, Unipol accounted for the first impact of BPER consolidation. Therefore, the 19 results I will comment on are normalized and exclude this accounting effect, in order to ease the comparison with the current results. Unipol pre-tax result showed an increase to 753 million in the first half 20 from 473 million in the first half 19, driven by a very positive performance of the non-life sector. The decrease in the result of life sector was mainly due to the negative contribution of the financial component, while the result of the holding and other sector was largely impacted by the unfavorable performance of Gruppo UNE. The consolidated net result was 617 million at Unipol, around 70% more than 353 million of the first half 19, and 560 million at UnipolSai, 377 million this time last year. Looking at the top line, the overall effect of the lockdown period I mentioned earlier is much more evident. Total non-life premiums decreased by 4.4% to 3.9 billion. Motor premiums decreased by 5.1%, while non-motor by 3.6% compared to this time last year. Looking at the three ecosystems, mobility recorded a minus 4.7%, welfare a minus 4.4%, and property a minus 3.9%. No significant changes to point out in the distribution channels, where 80% of the group premiums are sold by agency network, 13% by brokers and head office, 3% by bank insurance, perhaps the channel most affected by the lockdown, and 4% by direct and other channels. Combined ratio after reinsurance was 82.1%, a significant improvement over last year, thanks to a very low loss ratio, 54.6%, also impacted by the lockdown period. Combined ratio from direct business stood at 80.5%. On the life side, total premiums declined by 31.8% to 2.2 billion. The drop is partly due to the COVID-19 related economic crisis, but also to commercial policies aimed at containing the risk, and to the comparison with the first half 19, which was characterized by high production. In fact, last year production included a one-off item linked to pension funds for over 600 million. A strong point, despite the unstable financial context, is that the group's life companies recorded a very stable level of redemptions in the first half of the year, without peaks or situation of concern. Hybrid products, which are made up of a traditional and linked component, continue to represent the majority of the portfolio. Unit-linked performed very well with a 50% growth year-on-year. In terms of life yields, we register a good profitability. The gap between average yield and minimum guaranteed on segregated accounts remained sound and steady at 211 basis points. The guaranteed yield across the backbook is steadily declining, given that the majority of new products are sold with a minimum guaranteed yield of 0%. Total investments were 57.9 billion at market value. In terms of asset allocation, bonds represented 86% of the portfolio, with Italian govies weighing 48% on total investments. In the second quarter of this year, we decided to downsize the equity investment component, pursuing a risk reduction strategy in the financial portfolio. Financial yields from the insurance activities remained solid, with an overall running yield just below 3%, despite the negative effect of the risk reduction activity. The duration of assets was 6.3 years, 3.1 in non-life and 7.7 in life. The total value of the real estate portfolio stood at 3.9 billion, of which 53% allocated to non-life sector, 38% to real estate, and the remaining part to life and other sectors. No write-downs were booked in the first half of this year. Let's now turn to the NPE business. In the first half of 2020, Unipol REC reduced its gross loans by 179 million, with collections for 54 million, and it maintained a satisfactory recovery rate of 30%. 475 million was the amount of the net bad loans covered at 86%. Over the period, the company was able to realize net profit of 4.1 million, while lowering its debt level to 113 million from 155 million at the end of last year. The total equity at the end of June was 438 million. In terms of solvency, the ratio at Unipol and UnipolSai improved consistently compared to the figure of the first quarter, reaching a level close to that recorded at the end of 2019. That brings me to the end of my presentation. Thank you for listening. Let me remind you that our Group CEO and General Manager will be pleased to take any questions from financial analysts and institutional investors during the conference call scheduled today at noon CEST.